All right, 45 minutes after the hour, time for your active investor segment. Today we're looking at oil and oil stocks. Crude oil in New York dropping today, storms moving away from rigs in the Gulf, and there's concern about a macroeconomic slowdown which could crimp oil demand. Our next guest, though, says there's a couple of oil stocks out there that you should be owning. Let's find out what they are. We're joined out of Houston, Texas, where they got, as he called it just now to me, sideswiped by the storm. David Dahl, CEO of Cantley Trust. David, thanks very much. So it looks like the worst of at least the first storm is behind you from an oil production perspective.
Indeed, indeed. It looks like Aaron has made land down by Corpus. We've got 3 refineries down there, but most of the production out in the Gulf sits in that channel between Houston and New Orleans, and this tropical storm isn't really going to impact that. We've seen no evacuations for this storm. Of the 6,000 platforms out there, we've heard about no shut-ins or anything, but Hurricane Dean that sits out there at the Windward Islands, that could be something to pay attention to into the channel.
All right, so the price of oil down today, and I'm sorry, I just got in my ear that the Dow is down 300 points. I got to bring that up, so I was kind of distracted. So just quickly, David, the Dow Jones Industrial Average now down another 300 points to 12,554.19. As I said earlier, we hit that 10% official correction just about a half an hour ago. We were down from 14,000 July 19th all the way down to 12,600. So we hit the 10%. It is officially now, at least if you believe the 10% technical number, a correction here. David, I can't ignore this. I know we're here to talk about oil, and I'll go back to oil in just a second, but I just have to ask you, what do you make of what's happening in the stock market right now? Do you got to step in at some point and be a buyer here?
Well, valuations are going to become compelling. From our viewpoint, we're having a repricing of risk going on that the credit markets are experiencing, and there is a little bit of spillover into the equity markets. When you take a look at the differential between the large cap stocks to the small, even the international, the large cap stocks are not leading this downward move. You see it more in the small and mid, and even in some of the international positions. Our view, until it affects the building blocks of the economy, whether that's employment, earnings, GDP growth, this is a Wall Street event more than it's a Main Street event. You know, 2 of the stocks that you brought in for us that you do like longer term, Devon Energy and Amerada Hess. Devon is down 450. Hess, think that these are indiscriminate sellers here, and that the rest of us, you included, should be buyers into this weakness for some of these oil names? Well, nobody's escaping the punishment of this current market. We've seen a pretty strong momentum and movement to the downside, and whether it's Hess Corp or Devon, they're caught up in it. But both of them have some strong underlying fundamentals. Both beat earnings within the last couple of weeks. Both announced production volume increases. We like the position. Seasonality-wise, we've got some issues coming through the Gulf of Mexico, obviously, for Devon. Hess stands towards the high point of the range for oil prices. So both are pretty well positioned as long as the economy stays solid. Yeah, and given that the United States is the primary user of oil around the world, I think it's right around 20 million barrels a day of usage. Do you think if the U.S. economy does slow down, impacted by the credit crunch we're talking about, that the oil demand can be picked up by other nations, or will global oil demand thus fall, thus hurting the price of oil? Well, the effect there, if U.S. demand slackens, I don't know if we'd make the bet that worldwide demand would pick that up. Even though in Europe we're growing at stronger growth rates than here in the United States, the U.S. is the world engine, at least in the front of the GDP train. And from our viewpoint, any type of GDP slowdown that's more pronounced than what's built in presently, and certainly what we've heard from Fed Governor Poole, that slowing economy does not mean a receding economy. Until we get to that point, we think things are pretty stable and solid economically. You know, you look at people like, let's say, in my age group, in the mid-30s, got a long way until we retire here. And then you think about the market. Why do you think people aren't stepping in and thinking, 20 years from now, stocks are more than likely not going to be higher than they are right here? We're seeing a big sell-off. For longer-term investors, why aren't people stepping into this market? Well, right now it's tantamount to catching a falling knife, and with the amount of publicity, the amount of coverage going on, I think that fear can be a paralyzing effect for most investors. But when you follow the money on this, we've got a timeline that's in play here. Yesterday was the 45-day mark for hedge funds to get their redemption notices from investors. When we play out the liquidity events that are coming forth, we're going to see some good old-fashioned window dressing, some liquidation of positions between here and maybe the end of September. And then where's that liquidity going to go? People who are pulling out of hedge funds where maybe they didn't know what they were invested in, they're going to have liquidity returned to them in the first week or so of October, and that's going to find a home. You've been talking all morning about the credit market, and it's not going to find a home in 90-day T-bills that are currently yielding 3.5%.
All right, David Dalcio of Cantley Trust from Houston here. Good luck with the weather, David. Thanks for joining us. Appreciate it.
Thank you, Brian.
All right, Sandra.